Well, let's get more now on Freddie Mac. Standard & Poor's analyst Stuart Plesser joining us now by phone to talk more about it. Stuart, thank you. Hopefully you're able to hear at least part of what Eric was reporting on. What is your take? I mean, is there a way that we're overreacting or the market is overreacting here? And that it is, I don't want to say just accounting, but at the same time, is there a chance that Freddie Mac could be overstating some of the concerns?
Well, I mean, it's definitely a confusing income statement, to say the least, in how they account for some of these losses and whether they're ultimately going to turn out to be real or whether it's a hit right now. And I think the yardstick there that was put on during the call is they're looking at, the market is looking at about a 5% default rate on these loans and about a 30% severity rate. Freddie was hinting that that's too severe, but that's what they need to mark things down to at this point. So I guess it's up to the individual to say, if you think that that it will get worse than that, then these are not marked down enough. And if you think it's going to be better than that, these are marked down too much.
You know, so again, trying to find a little bit of a silver lining here, Stuart, is there a chance then that we should almost commend Freddie Mac in some ways for saying, we're going to do what other firms may not do, which is market to almost the worst case scenario at this point?
Well, you know, I mean, certainly that's, you know, admirable, and it's trying to give a clear view to investors of where things stand, and these are where the securities are selling in the market right now. So one could say, is the market overreacting to it? And, you know, again, that's an investor's choice. You know, I think that as these quarters are coming along, companies are starting to mark these securities down to where they should be. And the problem is that they just keep getting worse and worse. So when you're marking them down now, it doesn't mean you've marked them down fully. It's just it's deteriorating from there.
Stuart, it's Eric Schatzker here. Just a quick question. You were just referencing the 5% default rate that Freddie Mac says is being built into the market prices. They talked about 3 to 3.5% being the assumption that they're working with internally, even though they have to mark it down. Do you think that's realistic, or is that a little too overly optimistic, shall we say?
In my opinion, I think that might be optimistic. I mean, I think this is one of the worst housing declines that we've had, and it's just the nationwide sweep of it. It's not just particular areas, and so the default rates are going to pick up based on home price declines, and that's really the key in the whole assumptions is, you know, how far do you think home prices are going to go down over time, because that's what's going to trigger the default rates.
All right, Stuart Plesser of S&P. Stuart, we appreciate your time today. Thank you for joining us here on In Focus.
Thanks for having me.
All right, well, Freddie Mac, certainly bad news for it.